recording of the session today, and it will be made available later on, probably the next day or so, up on your website if you want to go back and review. So with that, we'll go ahead and get started here. We believe the Mutual of Omaha, now more than ever, should be a carrier you should not only be taking a very serious look at, but continue to take a very serious look at. All their financial ratings were just reaffirmed this past spring with an AM Best of A+. Being a mutual type of company, all of their focus is inward toward the policyholders as opposed to outward toward the stockholders. And also being a mutual company allows them to plan far into the future as opposed to quarter by quarter and watching Wall Street. This strong, stable, and secure brochure is something that we have here that we can supply to you if you'd like to use it as a handout for potential clients. So just let us know if you have any interest in that, and we do have those in supply here, and Golden Care has them as well. Kind of exciting news here is that we just got approval by the state of California for our rate structure, and we're right now in the process of rebuilding or building the software to support the offering in California, along with working with the state and filing the marketing materials. We're hoping to be back in California as early as October. Cautiously optimistic that will happen, but for sure before the year is out. But we've got kind of internal bets here going as far as certain dates, and October 1 seems to be a fan favorite. The long-term care, we call LTC 13, the Mutual Care Custom Solutions products were just recently launched in Florida a week ago today. So if you haven't seen it, take a look at it. The rate structure there is a little bit different than elsewhere. It's because Florida, I guess, presents its own internal challenges. So now,
hey,
yes.
Dave, I was working on the newsletter. I just was gathering up some of the stuff that we're going to be sending out, and I kind of was reminded about this. We just had a publicly traded major carrier withdraw out of California. I mean, Mutual stepping back in at this point in time. The timing couldn't be better. Just trying to make sure everybody's aware of just how significant this opportunity is going to be going forward.
Thanks, Mike. And I think that John Hennessy, our GM here, has been reaching out to a number of agents that used to write quite a bit of business with us back when United of Omaha was in California. And without any doubt, everybody's very excited about getting this carrier back into California, especially being a mutual type of company. But thanks for bringing that up. We've also just recently heard, too, that another major publicly traded company has done its third rate adjustment in just 3 years. That's all kind of shocking news to us as well. That's another benefit of working with a mutual company. Again, they can plan more in advance as opposed to being short-sighted. So now Mutual is up and running with the new Mutual Care Solutions in all states except Connecticut, Hawaii, Montana, and New York. So there's gold fever in Connecticut, Hawaii, and Montana, and New York. Take advantage of that platform for as long as you possibly can. We have no idea as far as dates for those 4 different states. I don't even think they've filed the new product yet in New York, but I know it is filed for in Connecticut, Hawaii, and Montana. Montana being unique because when it ends up being approved there, it will maintain the unisex rates. That's a state mandate for that state. So just keep in tune with us, and we'll keep you informed as far as the progress of the launch of the new product in those remaining 4 states. But again, it's kind of a hot sale going on in those 4 states. If you have any opportunities, now's the time more than ever to be working those cases. So why us? We believe it's more about how the policy will perform at claim time than what it looks like coming in the door. And what we mean by that is you should recognize the fact that the Mutual of Omaha policy is probably one of the most flexible policies out there when it comes to going on claim. It puts complete control of the benefits over in the policyholder's hands. They can elect to submit bills and get reimbursed the traditional way, which is strong, with a calendar day of limb as an example, or they can elect to cash day 1 and then use that money however they wish to use it to get around policy exclusions, maybe offset the cost of bringing a granny pod into the backyard. I mean, there's any number of uses that could be used with the cash. And again, the policyholder controls that benefit month by month, and with the secure product, it's a 30% benefit. With the custom product, it's a 40% benefit, tied to the home care benefit, as always. And then if you're using nothing but the cash benefit, obviously you're only drawing your monthly pool down by a lower amount. Therefore, the policy would pay out significantly longer. Adult foster homes is a topic of a very popular venue in the state of Oregon, adult family homes in Washington, and these are going to become more prevalent across the country as kind of a hybrid assisted living facility where they limit the amount of people who could live in these homes. Usually it's anywhere from 4 to 6 adults. Usually a little bit more expensive than assisted living, but less than nursing home. This policy offered by Mutual does cover those types of facilities, so as they come into your state, you should feel confident and comfortable about those types of facilities being covered. And again, the policyholder is in complete control of their benefits at all times. Asset protection, a couple of different ways your policyholder's assets can be protected. You're using the insurance company's money to pay for services, so you're either incurring expenses and getting reimbursed, or you're taking that cash benefit and running with it whichever direction you wish to go. And then, of course, if you build a partnership policy, compliant policy, you've got the asset protection if you still need help after you exhaust your policy benefits and are doing the required spend down for state assistance. One unique thing that you may not be aware of is that in most all states, and I'll show you a grid here in just a minute, you can actually buy into partnership. No one else offers this feature. An example would be if you're in a state like Oregon or Washington where the minimum percentage of inflation protection is 3% to qualify for partnership, you could start off at 1%, but if you buy up to at least 3% in the future, your policy from then forward is going to be a partnership compliant policy. So it allows you some peace of mind as to potentially offering a client a starting point that might be less than what your state has approved, but also keep in mind that the majority of the states where partnership is up and running have adopted the national rules, which in the national rules go all the way down to 1% compounding for lifetime and or cap benefits approved for partnership at all ages. Again, we put all this creativity in the inflation there for you to take advantage of so that you can really dial a premium in for where it makes sense for your client. For example, going from 5% to 3%, you actually knock half the premium off a case. And so each quarter point is worth a certain percent as well. So you can really dial it in and feel confident knowing that with the built-in buy-up feature where your client can increase that number over time based upon what their needs are at that time, they can do so with no additional underwriting. So again, it provides you potentially a little bit of ease of mind as far as not having necessarily to sell the 5, but to sell the 3, knowing full well that your client can increase that number over time. Yes, there is a caveat to it where that offer expires after 20 years and or the 75th birthday, whichever comes first, but again, it's a built-in feature, no additional cost. You can further be creative with the pricing of a policy by capping the growth of the inflation at either 10, 15, or 20 years. And you can do it where it makes sense. If you're working with a 70 to 73 or 4-year-old, they're still relatively young when it comes to the need for long-term care. It may not be for another 10 to 15 years before they use it. So take a look at capping that growth at a 10 or 15-year mark. Clients in their mid-60s or in their 60s, the 20-year cap obviously would make sense. And whenever a carrier can figure out exactly what their financial exposure could be at claim time, they're going to be a lot more realistic when it comes to setting a premium for that. And Mike, if you have anything to add during this, would you please just jump on it?
Will do.
Okay, here's kind of a grid, and I'll show you in the software as well. This grid is available for you to look at in the software too, the standalone version of the software. But the top grid here is the national rules, and you'll see the majority of the states have approved the national rules, which basically says all the way down to 1% is approved for partnership, all ages. And then at certain ages, the capping kicks in. For example, at age 56, the 20-year cap kicks in as being legal for partnership. At age 61, the 15-year cap, and at age 66, the 10-year cap. In all these states, obviously there's no buying into inflation in these particular states because these states did approve all the way down to 1%. So we broke it down by different category for you, and again, this PowerPoint will be available to you to look at in a few going forward, but also we have these rules published in our standalone software as well. You'll notice down here on this lower grid, in the Missouri, North Carolina, Rhode Island area, in North Carolina, you cannot get, partnership cannot be gained after issue. So that means that if you did start off, for example, at 1% and you're between the ages of 18 and 60, you cannot buy up into partnership. And the next slide will continue on. Virginia just came on here in the last month or so as being partnership approved, and it has its own unique set of rules. So it kind of stands alone, as does Idaho. And in Idaho, for example, they only approve 5. So the 5% lifetime compound, and then it just a little recently, or fairly recent, they approved the 20-year cap at age 61 and above. So that's a quick overview or review of the policy, which I'm sure most of you already understood how the policy worked fairly well and how to price it out. Now I thought we'd just give you a few underwriting tips. There's been a lot of conversations lately about this infamous CMP or complete metabolic panel and physicals. So we thought we'd just kind of walk through the rules with you so your eyes are wide open on a going forward basis. If you have a client, if you're working with clients who are under the age of 65, so 64 and under, and they have not had a physical with complete blood work within the last 2 years, they will not qualify for a preferred rate. It is not a disqualification for coverage, it just locks them out of the preferred rate class. So if you have clients go through underwriting and they're issued select, and that's the reason why, you have a 60-day window from that issue date for them to go get a physical with blood work to have the underwriter reconsider their decision. Or in your interview with your clients right up front, you can very easily ask them the question if they've had a physical and or blood work within the last 2 years. If your clients are 65 years old or older and they have not had a physical with blood work done in the last 2 years, that is the very first knockout question on the health questions section of the application. They cannot even apply if they have not had that accomplished. And also, if you're a fan of front loading, and that term is relatively new, but basically it means you're loading up the initial benefit and leaving the inflation off. The maximum benefit you can apply for if you have not had a physical with blood work is $8,000 a month. So if you want to max it to the $10,000 limit, your clients need to have had that physical with blood work done prior to applying. There's been a little bit of discussion over the last few months about the family history question. It's not a knockout question, but it's in the other health questions. Do any of the applicants who are applying for coverage have a history in their families, immediate family, of Alzheimer's and or dementia? It's not a knockout. However, it will limit the plan length to 5 years for what your client can apply for. It has no impact on the monthly benefit, no impact on the inflation, no impact on share care. It just has an overall limit of a 5-year exposure for that particular applicant. Anything else you want to add in here, Mike?
Not really. I mean, the front-loading thing, as you talked about, is becoming really, really popular. A couple things to keep in mind, about that. When the LTC09 product, when the product was re-rated or rate adjusted in the early part of 2012, 3% compound, which for that product was the lowest inflation option available, increased roughly by about 26%. The guaranteed purchase option, which was the no inflation option on that, increased by 3%. In an era where rate increases are going to become more prevalent and something that we have to deal with more and more, one of the added benefits of front loading, besides giving them everything right now, one of the added benefits is that we believe you're going to do as much as you can to keep them out of harm's way with regard to rate increases. The other piece, which doesn't get talked about a lot, is the idea of the intermediate exposure. What happens between age 60 and age 84? When you talk to them about 3% compound, we know that a lot of that conversation revolves around the idea that the benefits are going to double in 24 years, which is how the numbers work out. Well, what they don't think about is what happens if the client has and they buy it at 60. What happens when they have a stroke at 72? Well, they're somewhere in Never Never Land between the starting point and when they anticipate that thing's going to double. Given the costing working out pretty close to equal, what you're doing by front loading is you're giving them the whole thing now, so there is no concern about intermediate exposure. They know that they've got everything that they're going to have, which is very similar to most other types of insurance. From that perspective, it gives them everything that they've got, like you do with your homeowner's insurance, disability insurance, whatever it is. It's all covered right there.
All right, thanks, Mike. I appreciate that. Other little tips we can give you a heads up on. There's been another a little slight administrative change. I think Mike covered a big topic this pretty well at your meeting at your little getaway at Nevis, but they put some new steps in place to minimize the handling of paperwork going through the system. They assign case managers to all the cases, and it's knocked 11 to 12 days off the underwriting turnaround time. So we're pleased to see that happen, and we are seeing it happen in real life. They're also made another little minor change. When you do have a decline, and the decline letter is mailed to your client, they used to mail you a copy of it, but it was watered down with no real details at all provided. That's changing. That letter is going to stop, and they're going to be emailing you the decline information if you have submitted that agent HIPAA form along with your application. And I'll show you where you can achieve that form. So if you submit the HIPAA for agent form with an application, that allows the case manager and or the underwriter to have an open discussion with you as far as what's going on with your client during the underwriting process or during any questions about health or whatever. They can have that open and free conversation, which you've always been dying for to have over time. So that's a pleasant change to have happen. And when I show you where you can achieve supplies, I'll show you where that form is as well. And we have it here that we can always send it to you as well. But it's also being integrated into the app packet itself. But you can just hang on to it as a standalone form for your own use.
As Dave navigates out to the spot where he's going to show you where you can find that, if you don't have any other takeaway from the call today, we would recommend that you go out to the form site, email this form to yourself, and include it with all of the new business that you do going forward. It's form number M as in Mike 28704, and it's titled Agent Authorization or Authorization for Release of Information to my agent and or agency. And procedurally, when you get the email notification, which is, as you now know, is how you'll be notified of a decline, you respond immediately with a reply email back saying the release of information for agent is on file. Please provide the decline details, and you should have an email back within 4 hours with that information.
Cool. All right. Contact information. Supplies. Obviously, your first line of defense, as always, is to call us if you want. But if we're not around when you need supplies, there's two websites you can access. We set these up originally for both Axia and Long-Term Care Financial Partners, but now you still get there the same way by dialing the slash or typing in the /Axia or the /LTCFP. But where it's going to end up taking you, and I'll show you in just a second, is the map. Again, the underwriting hotline for Mutual, I'm sure you all have this memorized, but just as a reminder, it's 551-2059 option 2, and they no longer have pre-screen underwriters. You're going to be hooked up right with an underwriter directly. They take turns on the phones. There are a couple of them who work remote, and you may, like when you dial in, you hit 2, there might be a pregnant pause of silence up to 10 or 15 seconds. That's because it's linking up to one of the underwriters who works remote. Just hang in there. They will pick up. So, and again, our number is on there, and so does Golden Cares as well. So when you type in aimforltc.com/Axia or /LTCFP, it's going to take you to this website. We have renamed the website to be Axia Partners, but it's a map of the U.S., and if you hover over any state, it just gets all wavy and excited. And if you click on that state, for example, I'll go to Texas just for yucks, And it brings up, first of all, the long-term care section of it. Here's your mutual care app. There's a product brochure for custom. Here's the agent guide. Here's the magical HIPAA form for you, so you can have an open and free conversation with underwriting. We even include the Texas Shopper's Guide as an example for Texas, along with the regular NAIC guide. And then we get into critical illness. All the GTL information is here, the app, the brochure, and the rates. And we even included their hospital indemnity plan, the app, their brochure, and the rates as well. And these can all be emailed to you, downloaded to you. You can format it. You can compose an email and send it right directly to your client. You've got a lot of flexibility on this site. So again, if the GTL offering is available in the state you're hovering over, this material will be here. If you go to that state where it's not available, and if you don't see information on GTL when you scroll down, that means that the product is not available in that state. So pretty straightforward and easy to use. I'll go back here again. For example, you'll see Montana, Cali. Obviously, Cali has nothing right now. That's short term. But Montana, New York, sneak in there to Connecticut, and down to Hawaii. These are the 4 remaining states that are on the Assured Solutions Gold platform. And again, when Montana rolls out on the new product, it will be the only state in the country that is going to maintain unisex rates. Tell you what, Mike, I'm going to start at the top, and I'll start at the bottom, and we can start unmuting people and field any questions. Some people are on the conference call, and a big chunk are not, so I'll start at the bottom.
Again, if you do have...
if we're on speakerphone, if you please take us off speakerphone, because we're getting a terrible echo.
As you heard right there. All right, for any of the folks that want to ask questions that are not unmuted, we need you to input that 2-digit audio code. That will enable us to unmute you, and then you can fire away with questions. You can also always key them in on the chat feature here. And we do ask you to be kind to your partners with regard to keeping yourself muted, *6, if you don't have questions. Go ahead and fire away.
Yeah, they used to be in California. Can you hear me? It used to be in California. It was always a 6-month wait for the brochure lady in the DOI. I never opened the file until the product was approved. Is that still true?
Not quite. No, we're being, actually the home office is being cautiously optimistic that they'll get marketing materials approved relatively soon.
Well, I mean, that's a history. That's a couple years old. But John Hancock said that they heard it from the inside that they never even bothered to look at the brochure until the product was approved. And that one lady promised it would take 6 months for her to put her golf clubs down and do that. So.
Well, we'll check into that, but I know they do not review marketing materials until the actual policy is approved.
Okay.
We'll check into that for you.
Other questions out there this morning? Nope, I think she just put her golf clubs down.
Hey, Mike, how do you unmute, or can you hear me?
I can hear you, Pete. Go ahead.
If they're issued standard because they haven't had a physical in the past 2 years, and they decide during that 60-day period to go get a physical, can that physical change the underwriting decision?
Absolutely. Absolutely.
I mean, for the worst as well as for the best.
No, they're already issued select, so they can't get a worse category. They can only go up.
Right.
Okay.
Because they've already reviewed the medical record, so they have the medical history. They just haven't got current stuff.
Lab work, right. Right. All right. Good question, Pete. Anybody else out there with questions?
This is Jack in Seattle, not with a question, but with a comment.
Okay, go ahead, Jack.
I think the best thing about selling Mutual of Omaha Solutions is, well, the presentation software for the illustration, Mutual Care Solutions, is wonderful, terrific software. Please mention.
Well, we agree. That's why we consistently try to sort of guide/maneuver folks in that direction because it is such a strong point-of-sale tool.
Yeah, we're kind of proud of that. That's actually built here in Yakima. This gentleman has been building quote software with us going back into the mid-'80s. for quote software for various companies for various products. He's the son of an agent, and basically his dad said, build it so I can figure out how to use it without having to read one instruction. So that's kind of the approach we take. It's very intuitive. But anyway, I'm glad you like it. We understand that majority of you use Stratecision, but when in doubt, go out and check out the standalone version. Like I said, the rules for a partnership are in the software. In the standalone version, there's a little green button labeled tick inflation. You click on that button, and it'll bring up the rules for the state you're quoting in as far as what's legal and what is not.
We've also added a web call to it that will automatically tell you if you're online whether you have the current version or not.
Yeah, every time you open it up, it does a handshake with a mothership, and if you're down a version, it will tell you that and prompt you to update your software as well.
All right, appreciate the comments, Jack. Anything else out there this morning?
Hey, Mike, it's Tom Magnus out here in Nevada. I joined a couple minutes late. What is the launch date for California?
We're anticipating it'll be the start of the fourth quarter based on the feedback that we're getting from the home office, and that's based on what they're getting from the state. We're cautiously optimistic in that direction. A lot of money on a couple of betting pools here with 10-1 being the fulcrum.
Yeah, okay. All right, cool, thanks.
All right. Anybody else with questions out there?
Okay. Well, listen, Mike and I really do appreciate you taking the time to join us today. Like I said, we'll have this recorded and over to Tracy and Janet to post up on your website. We do sincerely appreciate you taking the time on a Friday to take a half hour of your day to spend time with us. And if you have any questions on a follow-on basis, feel free to call either Mike or me at 800-672-7202.
Thanks, everybody. Have a good day.